how to use revenue to be able to get money. So what's nice about this is that today you're going to understand that if you just have cash flow in your business, a lot of ways, a handful or more, right? Plus, plus, plus. I typically under promise and over deliver. So a lot of ways that you're actually able to tap in and use the fact that you have consistent revenue as a way to be able to get money for your business. So what's nice about this is we're going to talk about ways that aren't based on your personal credit. You don't have to have collateral. They're unsecured. So even if you've been turned down for banks, can't get SBA loans, don't even have your business credit established, there's a lot of ways we're going to talk about today just based on cash flow and cash flow alone that you're able to get money for your business. Now, if you're getting value from this, don't forget to check out Business Credit Toolbox, and you can easily go to check this out at Business Credit Toolbox. And our Business Credit Toolbox is basically, if you use hashtag Business Credit Toolbox, you're able to get about $300 worth of free goodies. So if you get value, and check this out, and also make sure you share our future streams, so you're able to tap in and get a bunch of cool stuff. All right, so let's dive in. So a lot of options for growing in your business and getting money, even if you don't have good credit, even if you don't qualify for a lot of other kind of financing. So the biggest thing is you really need to make sure that you're proving that you have consistent revenue. I'm still shocked by the amount of people that I speak to that just do not do this. And what I mean by that, I'm shocked by the amount of people that don't verify that they actually have cash flow in their business. So I'll give you a perfect example. A trainer buddy of mine that I know, he still runs all of his money through his personal bank accounts. And that's just shocking to me because now he's looking to expand. He's looking to be able to get money for that expansion. And the first thing I said is, I'm like, well, you have all your business revenue going through your business bank account, right? He's like, no, I didn't have a business bank account. I'm like, why would you do that? I mean, you literally could sit here right now and get money, but because you're running it through your personal accounts, you eliminate the large chunk of funding options. When I look at the easiest to qualify for financing options that are out there, this is it. Money that's just based on your revenue. So if you want fast, easy money, then the category that is the best for fast, easy money is money that's lent to you just because you have consistent revenue. But rule number one is you have to verify that you have revenue. If you have your money going through anything other than a business bank account, you need to immediately fix that. And by immediately, I mean like today. You need to leave this live stream as soon as it's done, get the advice, and go to your bank and open a business bank account. You could do so for less than $100 in the account. Sometimes it's $20, $25 to open it up. And then start putting your actual deposits, your cash deposits, your credit cards running through your business bank account. When you do this, it goes a long way to then helping you create a track history, a history of being able to actually produce consistent revenue. And that alone opens up a lot of funding options. So by the way, if you're just coming in, tell me where you're coming in from. Always love to give you a shout out. So make sure you're coming in and make sure you're saying hello. Okay, so again, per Investopedia, when we look at this, revenue is company money earned from selling product services, measures sales and marketing effectiveness, and cash flow is net amount of cash transferring into from company, more of a liquidity indicator. So if we look at this, revenue is the money that you're basically earning from all of your sales, and cash flow really has to do with the money flowing through your bank accounts and your business, the money coming in, the money going out. That's what we talk about with cash flow. So we've got to make sure that we have both. We want to increase our revenue. And we also want to have money available to our bank account. What I mean by that is that, for example, one of the factors that lenders look at is, do you have a positive ending bank balance at the end of each month? So do you have more money going into the bank account than coming out? Do you have a positive ending bank balance? Those kind of things are really crucial to making sure that you actually have positive cash flow and are set up in a position where you can actually be able to qualify for a lot of the kind of financing that's based on that. Now, regular earnings mean your business has a future. Lenders love that. Professional, prepared financial documents, lenders love as well. So what I mean by this is having regular, consistent money is a really big deal. Look, you can make $300,000 as a real estate agent, but still have a really hard time getting loans because the money you have going in your bank account more than likely isn't consistent. You don't have 5 or 10 or 15 transactions every single month going through your bank account. You might only have a big deposit here, a big deposit there. If those deposits aren't consistent, lenders really don't like that. And it's hard to get money based on your revenue or cash flow. The other thing to keep in mind, again, the other side of that is that you're a retail store, right? And you have money every day going into your bank account because people come in, they buy stuff, your merchant account settles out, dumps into your bank account. That's a difference. They would rather lend to somebody like that than a real estate agent, even though a real estate agent can make considerably more. So the consistency of those deposits is very important. The second thing is having Financial documents to verify this is also important. At least you should have business bank statements. It also makes sense to have a P&L done every single quarter. Have a profit and loss, have a balance sheet done. Look, if you don't know how to do those, you can go onto Fiverr or Upwork and hire somebody for very little money to be able to come in and help you if you're giving them the right amount of stuff. And you can look on there and find tons of people on Upwork with like, positive reviews, so you could verify and validate who they are and their reputation before giving them any private documents for your business. But again, you should have a P&L and a balance sheet. If you can't afford a bookkeeper, a CFO, and a controller, there's all kinds of interim people that can fill in for that. Okay, so they just come in to help you when you need them, versus somebody that you have to add to your payroll. And again, there's all kinds of places, even on places like Upwork, that are people have a lot of accounting experience, even maybe, bachelor's or master's degrees in that can help you as well. But you're typically going to need a P&L and a balance sheet for better kind of loans and financing. It goes a long way to helping you get approved for things like insurance, amongst many other types of financing as well. So 2 things to keep in mind: make sure that you can verify that you have consistent income, and make sure you try to make your income as consistent as possible. They really like to see your income staying the same or going up. The other thing is having documents like P&Ls, balance sheets goes a long way as well. And again, if you're just coming in, tell me where you're coming in from. I always like to give you a shout out. Just say, hey, it's Ty from Tampa, Florida. And let me give everybody a shout out that's here. Okay, so providing income. A lot of different ways that you can get money based on this, from credit card sales data, business bank statements, business tax returns, account receivables. There's a lot of ways they can look at how you're actually earning the income. So get more in, right? FICO score or time in business might mean that you don't get big offers. So why not stack loans? Okay, so this means you can get multiple loans instead of just one. Look, a lot of lenders will look at things like credit score and time in business. Now, fortunately, when it comes to revenue, lending, cash flow financing, money based on your revenue or cash flow, your FICO score doesn't really matter. You could typically get approved even with pretty bad credit. The second thing is time in business only really matters. It will help you get lower rates, but it only matters if you have the 6 or 12 months they're looking for. If you have the 6 or 12 months that they're looking for, and it's different based on the lender, then they're typically going to approve you for financing, but you can get lower rates, sometimes more money if you have longer time in business. But stacking loans makes a lot of sense. And you hear me talk about this a lot because this is what the most successful entrepreneurs do. What we do is we stack financing. We get multiple different kinds of financing as well. And when it comes to cash flow financing, a little secret that's an industry insider secret that a lot of people don't know is that you can stack these and get what's called second and third position financing. So for example, if I get a loan based on my revenue, well, then there's a lot of lenders that just because I got the first loan will give me a second or a third loan based on my revenue as well. So if you might qualify for 25 grand with the lender and you wanted 40, but what you might not be taking into account is there's a second and third position lender that would give you well over the 40, 50,000 that you're looking for if you stack those loans and got more than just one. So something to keep in mind. In Sanford, Florida's in the house. Not a lot of people giving me shout outs today, but tell me where you're from and I'll give you a shout out. So second and third position, what this means is it basically means that you've got a loan in second or third position behind the very first one that you get. Okay, and what that second position or third position really means definition-wise is it just means that if you ever default and the lender ever has to pursue your assets, etc., then the person in first position, the first lender, is going to have first dibs over whatever assets may be there, then second position, then third position. So all this means is it means that the lender's willing to take more risk and even go into a second or third position of ever being able to get their money back. So the rates are typically high because of that second or third position, but this stacking of loan helps you get more money than what the first lender will oftentimes give you. Okay, now most lenders prefer to lend only for the first position. They don't want to be in second or third position. They know they're not going to get their money. So let's say, for example, that you have revenue lending, you get first position, second, third. And then let's say that the business that was lent the money goes bankrupt. Well, it's even a jump for the first position lender to get their money back out of that bankruptcy. Second, third position rarely ever does. So these are very high risk scenarios, but that's why there's not a lot of lenders that do second, third position financing, but they are absolutely definitely out there. And this is why we're talking about it today, because it's one really good way to stack loans to get money when a lot of people don't even know that this financing option's even out there. Okay. Now what happens is this is where UCC filings come in. Whenever you get financing against an asset such as your collateral like equipment or even your cash flow, well, then they'll usually file what's called a UCC filing just to let other lenders know that you have that is actually being used as collateral. So keep that in mind, that it's not uncommon to get with a lender, then put a UCC filing on your business credit report. Then it makes it harder for other lenders to come in second and third position to be able to do that. And Major CI or CY says, hello, I bought an aged shelf corporate, was incorporated in 2007. Would my time in business be 2007, even if I go in the EIN for the company a few weeks ago? So if your actual entity was set up in 2007, that would be your time in business. But you've got to keep in mind that shelf corporations, age corporations are very, very, very problematic when it comes to lending. And what I mean by that is that, lenders understand that most people are only buying shelf corporations or aged corps because you're trying to qualify for financing. You don't qualify for contracts. You don't qualify for, etc. So when this typically happens, you bought the corporation from somebody else. The problem is when that happens, there's an ownership change. And when that ownership changes like that, the credit bureaus automatically alert people. There's automatically red flags put on your business credit report. And they actually basically go through the equivalent of re-aging your credit report to basically tell lenders or credit issuers, hey, this company was just bought by somebody else. And a lot of lenders and credit issuers will still consider to be the new date, the day you open the bank account as the start date of the business. And this is why I always advise people not to buy shelf corps, because you have to ask yourself why you're doing it. And people say, well, it tells lenders that I'm in business longer than I have been, but it really doesn't, because lenders will actually know the re-aging, know you bought it, and they'll count the day that you took ownership or the day you opened the new bank account as the start date. Not to mention that anything else happens on that, bad items on your business credit report, liens, debts that the old business owned, you're now liable for. So some things to keep in mind on that. But yeah, absolutely, the date of the actual time you set up the entity is the start date of the business. And that's almost always the case. The time it's not the case is when you're describing, when you buy an aged corp, they'll typically re-age it and look at when the ownership changed on that or the bank account start date. So some things to keep in mind there that you may face. And 3100 Apparel says, hello, Jay from 3100 Apparel in Las Vegas. Hey, Las Vegas, I'll be out there later this month, actually speaking. So hopefully maybe I'll run into you when I'm out there. And hello from Georgia. And thanks for saying hi, Tanya from Georgia. Thanks for coming in. So terms and qualifying, as I mentioned, second and third positions, definitely riskier. They're going to be lent to people that have longer time in businesses, higher credit scores, more consistent revenue. That's what lenders are really looking for in those. Now, first position are often going to give you about 15% of whatever your annual revenue is. And second and third position will be a fraction of that, even as small as 5 or 10% of whatever your annual revenue is. Rates are all over the board. Usually when it comes to cash flow financing, revenue lending, we can see rates on the low end of 8 to 10%. And on the high end, we can say 30, 40, 50% or more. Things that determine your risk, how long you've been in business, what your consumer credit score is, your business credit quality, also how you manage your bank account. And by that, there's about 4 or 5 things they look at, like how long has your bank account been open? How much do you have going in deposits versus going out? Do you have a positive ending bank balance at the end of each month? Do you have non-sufficient funds? Like, are you overdrawing the account? Those are all things that lenders are really looking for to determine risk. And that risk determines the rate and how much money that you'll actually get. So you also have to keep in mind that you can also get fast money, not with just revenue lending. And revenue lending is a great way to get money. But just because you have money coming in consistently from customers and you're letting them pay you on terms, that's what's called account receivables. We call this factoring. We call this account receivables. We call this AR. And what all of this stuff is it just basically means that we let our customers pay us on terms. So that means if a customer comes in and owes me $3,000 and I let them pay me over 7 months, that's what AR is. That's what account receivables are. So that was a way you're able to leverage those and actually be able to get financing where you're leveraging your outstanding payments to get a line of credit or a loan. Okay. And oftentimes lenders will go as high as 80%. We even have funding sources that will go as high as 90% of whatever your actual receivables are. So if somebody owes you $100,000, well, then a lot of lenders will give you up to 90% of that advance in as little as 24 hours. So instead of letting them pay me $90,000 or $100,000 over 7 months, then I could actually get 90,000 of that 100,000 the next day. And the rest of that extra 10 grand minus their fee comes back to me whenever the actual customer pays through with all of their payments. So it's a really nice way to let your customers pay you on terms and still get the majority of your money right away. And I also like this because they go by what's called factor rates, and the factor rates are very low, oftentimes less than 2%. So very affordable to be able to get AR financing. A lot of them don't even look at personal credit scores, go as high as 90 or go as high as 90% of your receivables. Okay. And you can get up to $20 million in funding with this as well. So really interesting way to be able to get money for your business and letting your customers pay you on terms as well. So you also can offer net terms to customers and get net terms through business credit. So startups in particular have got to kind of prove themselves to customers and prospects. But how do you do that? Well, offering net terms is one way to do it. So you're actually able to come in and let somebody pay you within net 30 or net 15 or net 55 or net 60. So one side of that is letting your customers pay you and give them a little bit of time to pay. Okay. And that helps you attract more customers as well. But when we talk about net terms, these are most well known in the business credit world. And keep in mind, over 90% of people that issue credit don't report the credit to the business credit reporting agencies. And the reason I'm telling you this is that there are tens of thousands, if not hundreds of thousands of companies in this country that will give you credit to buy their products and services. They give you terms. They let you pay over 15 days, 30 days, 60 days, 90 days even. So these net terms are something to keep in mind, especially if you're a newer business, to offer them to your customers, give them more time to pay and attract more customers that way. And also you can build business credit as well. And business credit doesn't look at the cash flow of your business, but it also is a really nice way where you're able to come in and you're able to actually get terms as high as 2-3 months to pay stuff back. So you're able to actually get credit cards, build your business credit, and get net terms on the amount that you're getting as well, or on the actual credit that you're being issued. Another thing that's similar here based on revenue is called merchant cash advances. And these are called MCAs, merchant cash advances. Typically, you only need about $5,000 a month in revenue and be 6 months time in business to qualify. So even if you have bad credit, you're able to oftentimes get approved, and it's just based on your credit card sales. So if you have consistent credit card sales in your business, consistent money going into your business through Visa card, MasterCard type of credit cards, then this is one of the fastest, easiest types is an MCA. I mean, typically 6 months in business, you're talking about $5,000 a month in revenue. And again, they just want to see you have some consistent deposits and that you're managing your bank account the right way. If you're doing this, chances are very good that you're able to get approved. Frat Boy says, Trey from Colorado, have a couple of positions I'm paying off. The money is expensive, but the banks are impossible to get funding from, and they move slow. So something to keep in mind here, and Trey is bringing up something pretty common. A lot of people get these first, second, third position loans, then they look to consolidate. Trey, you can give us a call on that as well. You can go to this link at creditsuite.com/get funding, or give us a call. We could do a free finance assessment. Term loans work best for what you're describing. Term loans are usually a little longer, 2, 3, 4, 5 terms, 2-year terms, and they're very popular for condensing and combining multiple position cash advances if that's what you have. So I would look into term loans. It's an alternative. It's an answer for what you're describing here, and we can guide you to some sources that can help you as well. Just let us know. And good afternoon, everyone. Tavanda is watching from Houston, Texas. Tavanda, thanks for coming in and saying hi to everybody. Appreciate everybody giving us a shout out. So 2, get a reusable line of credit. That's really going to be good for cash flow, right? So when we talk about being able to use consistent cash flow to get money for your business, there's 2 credit lines I really love. The first of which is Fundbox. And Fundbox is real easy financing. They kind of prefer you have about 600 credit scores. We've seen them approve people that don't have that. They want you to have at least 6 months worth of time in business. They want you to have, of course, the things we talked about with how you should manage your revenue, consistent revenue, more money going in the bank every month and coming out, positive ending bank balance, don't have a bunch of non-sufficient funds. If you're doing those things, then there's a great chance you can qualify, because Fundbox is just based on the predictability and consistency of your cash flow. So if your cash flow is predictable, if it's consistent, then there's a good chance you're able to get approved, and they approve you for as much as $150,000 with no minimum FICO requirements. So a really good way to go. And they'll give you a 12 or 24-week plan to pay the money back. Interest as low as 0.5% for every year outstanding. So something to consider there. Another alternative is Blue Vine. I like Blue Vine, but they're a 620 FICO score, so they're a little bit harder to qualify for. But Fundbox and Blue Vine have really easy to qualify credit lines. Oftentimes, you're able to get approved for their credit lines in as little as a day, and sometimes get access to your credit line completely within 24 hours. So these are two really good options to go with. When it comes to credit lines, these are two of my favorite, both Fundbox and from Fundbox and Blue Vine. Now, if you want to get a lot of money quickly, well, then you might want to consider offering something up as collateral, including real estate, okay? Because that could be a really good way to go, is if you have something that's based on some kind of value, equipment, inventory, even real estate, then this is a way you could tap into that to get money quickly with really low rates as well. So some things to keep in mind there without giving up equity in your business. A lot of things, equipment, inventory, commercial real estate, vehicles, all those kind of things can work. And again, we talked a lot about business revenue lending as well. And this is a little bit easier to qualify for than most, but harder to qualify for a merchant cash advance. Usually they want you to have about a year's time in business. They also want you to have about $10,000 a month in revenue, but they'll give you, ultimately 3 months terms all the way to 3 or 4 year terms. And the FICO score has to be about 500. So a good way to be able to go there if you have about 10,000 a month in revenue or 1 year time in business, which is what they look at. So a lot of ways that you're able to get money here based on revenue. We talked about revenue lending. We talked about merchant cash advances. We talked about credit lines like Blue Vine and Fundbox as well. And even if you have assets, it's not really a cash flow based financing type of financing, but something to consider is leveraging those to get money is sometimes better than equity financing that you might run into. Don't forget about second, third position cash advances and revenue lending. Those are really popular ways you're able to get money as well. And we also talked about term loans. Term loans are better terms than some of these that we talked about, revenue lending, merchant cash advances, and they're great ways to combine and condense second, third position loans even to just one. But remember, all this comes down to being able to prove your income. So you've got to have a bank account for your business that you're running all your money through. And then you really want to consider a P&L or a balance sheet that you get done every quarter or so, because there's definitely some funding sources out there that would like to see those as well. If we can ever help you get money, all you ever have to do is give us a call. If you give us a call at 877-600-2487, we never charge you any money to get financing. We'll go place you with the lender. We'll tell you the best lender, the best product. We have over 1,000 funding sources, every legitimate type of loan product that's out there. So we could definitely help you get the money that you're looking for your business. And again, it's like having a free resource there to help you along the way. All you have to do is give us a call. We'll do a free finance assessment. We'll actually do a fundability check to help you fix the stuff that's not right with fundability. So lenders want to give you money. We'll get your business credit reports, even give you tips and tactics to be able to improve your business credit to get better terms on the money you get. And we'll do a finance qualifier just to tell you all the money you can qualify for right now. All you ever have to do is give us a call at 877-600-2487. Tavonda gave me an awesome thumbs up. I love this icon. That's the coolest chat icon I've seen him put. It won't even let me show this. I just have to tell people how cool it is. Well, let me show. But I love that. Thank you all very much for coming in. Tell me where you're coming in from, saying hello. I look forward to seeing you on our next training. If you got value from this, make sure you like and subscribe. And we'll see you tomorrow, where we always have a podcast interview guest on with us. And then Thursday, we'll talk about more cool ways to get the money you need to start and grow your business. Thanks for tuning in.